In today's video, we're going to be talking about holding companies. We're going to be discussing what holding companies are, what are their benefits, what are their drawbacks, and other considerations. Hi, welcome to my channel. My name is Irene and I'm a CPA here in Canada. I post videos explaining important accounting and tax concepts using simple language to help business owners gain financial clarity. Make sure you hit that like and subscribe button for more. So what is a holding company? Let's start with the basics. A holding company is a company whose sole purpose is to hold assets rather than providing a good or a service directly to customers. Holding companies can hold assets such as a stock portfolio, real estate, shares of private corporations, and other assets. So now you might be wondering, why would someone want to create a holding company? Well, there are several benefits. One of the main benefits of having a holding company is for asset protection. So an operating company is the company that provides a service or a good directly to customers. And as a result of daily operations and transacting within the business, the operating company is exposed to legal risks. So now with an example, I'll illustrate how a holding company can be used to protect assets. So let's say, for example, you started a business. You started a restaurant, and in the last 10 years, you grew it and now it's super profitable, your restaurant business. Your restaurant is considered your operating company because that is where you do the work, where you generate the money, etc. So now let's say over the last 10 years, whatever, your restaurant operations are super profitable now. So you're taking the excess profits generated from the restaurant, and you're going to use that money to invest in a stock portfolio. So now that stock portfolio is considered an asset of the restaurant. So let's say one day a customer comes into your restaurant and slips and falls and has a fatal accident, and then they want to sue you. And so what happens now is if they sue the restaurant, all of the restaurant's assets, including the investment portfolio, is now at risk within a lawsuit. So we're rewinding it back a little bit. Over the years, your company is becoming profitable. The restaurant is generating a lot of excess profits. So you guys are moving the profits into the holding company as an intercompany dividend, right? And then the holding company, which is a separate legal entity that is still controlled by you, that holding company can now invest in a stock portfolio. And so in the same scenario, if a customer comes to your restaurant, slips or falls, and wants to sue the restaurant, the stock portfolio is not an asset of the restaurant, but instead an asset of the holding company. So if there was a lawsuit against the restaurant, then the investment portfolio would essentially be protected against that lawsuit because it's not owned by the restaurant. Another benefit of utilizing a holding company is to maintain eligibility for the lifetime capital gains exemption. One of the most powerful tax saving tools in Canada is the lifetime capital gains exemption. This exemption is a mechanism whereby on the sale of qualified small business corporation shares, QSBC shares, up to $971,000 of the capital gains can be exempt, aka tax-free. The lifetime capital gains exemption is indexed for inflation, so it changes every year. At the time of the recording, the exemption amount is $971,000. So let me illustrate this in an example. So let's say when you first started the restaurant business and started it from the ground up and you incorporated it. At the time when you started, you spent $1 to buy shares into the restaurant corporation when you created it, right? And over the last 10 years, you've put your blood, sweat, and tears, and you've built the value of the business up now. And now the valuation of it is $1 million for your restaurant corporation, right? Now come along Bob, and Bob's like, hey, I want to buy your restaurant. And you're like, you know what? Let me sell it to him. So you sell it for proceeds of $1 million, right? And because you spent $1 when you first started the business buying into the shares of the company, your cost base is going to be $1. So when you calculate the capital gains, which is going to be $1 million minus $1, the capital gains is $999,999. And so essentially you would have to pay tax on that. But what the lifetime capital gains exemption allows you to do, assuming that your restaurant is qualified small business corporation shares, then you'll be able to use the lifetime capital gains exemption that you have for yourself to help you shelter $971,000 of that gain. So now the revised capital gains that will be subject to your tax is only about $28,000, right? And you only pay 50% tax on that capital gains, which is significantly less than had you not been able to access the lifetime capital gains exemption of sheltering $971,000, because otherwise you would have had to pay tax on 999,999 capital gains, which would be 50%, which is $499,000. So now you can see how the lifetime capital gain is such a powerful tool. However, in order for your shares of your private business to be considered a qualified small business corporation, there are certain tests that you need to meet, that the company needs to meet in order to maintain this eligibility or be eligible for it. So one of the tests is that a certain percentage of the corporation's assets must be used in active business. So that means if the operating company, so your restaurant, has too much standby cash on hand or has too many passive investments like a stock portfolio, it may potentially disqualify the operating company, the restaurant, from that QSBC status because the test is not met. So instead, how incorporating a holding company into all of this can help maintain the lifetime capital gains exemption eligibility is that you would essentially have all of the passive assets and the excess cash moved from the operating company into the holding company that, again, you control, and have all of the assets held within that separate legal entity so that the operating company, all of the assets used within the operating company can meet the test and pass the test to become the QSBC status, so that in turn, when you sell, you can use your lifetime capital gains exemption. So another benefit of utilizing a holding company is for tax planning opportunities. More specifically, having flexibility over the timing and the payments. So now let's go back to the example of you owning the restaurant. Let's say you own the restaurant with your friend John. You guys are 50-50 shareholders, okay? And let's say the restaurant business was very profitable during the year, and the restaurant is going to issue dividends out to you guys as the shareholders, $300,000 each. Now, let's say you live a very modest lifestyle and you don't need $300,000 to live to pay for your personal expenses. Well, John, on the other hand, needs $30,000 because he's buying a house or something, let's say, for example. Now, in this instance, if you were to take that $300,000 dividend directly into your personal hands as a dividend, then you would be paying income tax on that at the highest tax rate, right? However, like we said, you live a modest life. You only need $100,000, right? So instead, holding companies here could be really useful, where your holding company, John's holding company, are the ones who actually own the shares within the operating company, and the restaurant's operating company is going to issue dividends out into the holding companies, you and John's holding companies. $300,000 here, $300,000 here. And now at this level, you have the flexibility of determining what dividends you want to issue yourself to be subject to your income tax, right? And then John could do his own, you could do your own. So going back to that example, you only need $100,000 to live. So at the holding company level, you can issue yourself a $100,000 dividend, which will not make you in the highest tax bracket. You see how now you've deferred tax on that $200,000 you left within the holding company. So all of that tax is going to get deferred on to a later time when you actually withdraw the money. That's how tax planning can really come into play and actually save you thousands of dollars if done correctly. Given that you are the person who owns and controls the holding company, at a later time, you're able to strip money out of the holding company if you need it for your personal goods, etc., etc. So that's kind of the idea of tax planning and deferral and etc. So another benefit is that holding companies can be used as an investment vehicle to grow and hold your investments. Oftentimes, holding companies are used as a retirement fund from business owners who have earned income through their businesses and then later on accumulated assets and grew their assets within the holding companies. And then later upon retirement, they start to strip money out of the holding companies and live off of those assets. Another benefit in utilizing holding companies is for estate planning / succession planning. Holding companies are often used as part of the structures in the special tax reorganization work. So for example, in an estate freeze where you want to pass down the business to the next generation, and you're able to pass down the assets in the business in the most tax efficient manner while still maintaining control until the next generation is kind of getting up to speed with actually managing, operating the company. How can you go about setting up a holding company? Well, just like any other corporation, you have to incorporate your holding company. You go to the lawyers, get your incorporation documents drafted up, and then you'll be able to have the holding company all set up as a legal entity. If you're looking to add a holding company into your existing organizational structure, so including into your operating company, your family trust, etc., in order to introduce the holding company into all of this, you have to undergo a corporate reorganization. In order for you to go through a corporate reorganization, it is so important for you to engage with a tax specialist who has the knowledge and expertise in conducting such work like corporate reorganization. Oftentimes, when you are moving companies around, shuffling assets around, oftentimes those will trigger a tax consequence. However, there are tax elections that can be made to have these reorganization done on a tax deferred basis. So that's why it's really important to engage with a CPA who knows how to do this type of special tax work. Corporate reorganizations are extremely complicated and can be costly as well too. So it's really important to seek professional advice. Now let's talk about the disadvantages of creating a holding company. The first disadvantage of creating a holding company is that now you will have additional costs. So you're going to first have to incur incorporation costs to set up the whole holding company, right? And then you're going to have your maintenance costs. So every single year, you're going to have your holding company have a corporate tax return filed, year-end filed, the annual legal filings as well too. So those are the maintenance fees, right? And then on top of that, if you are looking to add a holding company to your existing corporate structure, like I mentioned, you're going to have to undergo a corporate reorganization. And oftentimes those are very costly and time consuming sometimes as well too. So it really depends on your situation, because sometimes the additional costs will actually erode some of the benefits, the cost benefits of even having a holding company in the first place. Another disadvantage to adding a holding company to your structure is that it increases the overall complexity of all of your affairs. When you're adding a new holding company into your corporate structure, you're essentially adding a brand new company, a brand new legal entity as well too. And now you're going to have more administration costs because you have to make sure that all of your companies are abiding by the tax deadlines, paying their taxes, filing their taxes, and just overall complicates all of your affairs. So there are some instances if you don't meet a certain threshold, you don't necessarily need a holding company structure type of deal yet because you won't fully benefit from it. A holding company could be very beneficial, or it could be counterintuitive because of all the added stress and the cost that erodes any benefits that come with it. So I really highly suggest you to consult with a professional, a CPA, to get more information about your specific situation, because as you can tell, it can get very, very complicated and it's very tailored to what your needs are. Thank you so much for watching until the end of the video. I hope today was helpful. Make sure you hit that like and subscribe button for more. Over here, YouTube thinks you're really going to like this video, so I'll meet you there.